Okay, so one of the most frustrating conversations I have with clients or prospective clients is that they will say things to me like, it's all very well and good, John, but unfortunately we're a loss-making company. And we've been told that we can't make a tax claim because we haven't paid any tax. Okay, so that's not the case with R&D tax credits. Okay, so they're not just R&D tax refunds, they're R&D tax credits. So if you're in a loss-making position already and you are engaged in qualifying activity, you are able to cash in the loss. Now, this is all usually greeted with some degree of consternation because it generally doesn't make any sense. It's like, how can that be? Well, the whole idea of it is that effectively, if you're engaged in qualifying activity, you will be effectively rewarded by HMRC, so to speak. You will be engaged in the activity. You can then say, yes, we've got this amount of cost that we believe is qualifying, and then we make a calculation. Now, the calculation itself is quite unusual. So the way just a normal R&D calculation works is that if you identify £100,000 worth of qualifying costs, that is enhanced by 130%. So effectively you put £130,000 worth of qualifying costs as an expense on your tax return. So that effectively knocks off £130,000 worth of profit if you were profit making, and then you get the tax benefit of that profit. So with the loss making situation, if you were already loss making, it works in a slightly different, it works in the same way, but the calculation can be misunderstood by people. So what you have is, if for example we've got a company that's already, before any R&D is applied, makes a loss of £200,000, say, and if we identify £100,000 worth of qualifying costs, that is enhanced to £130,000 of cost, then your new loss is £330,000. So, great, we can cash that in. No, you can't. The reason you can't is because there is another phrase which is called the enhanced R&D expenditure. Now that is the original qualifying expenditure plus the enhanced number. So in this instance, it would be 100,000 plus 130,000 equals 230,000. And the rules are that if whichever is the lower of the new loss or the enhanced R&D expenditure is the amount that you can cash in. So in this instance, it will be 230,000 times 14.5%. And then the remaining loss can then just be carried forward. That remaining loss cannot be recashed in the future. So that's just a preserved loss that carries on for the remainder of the future. So that's how that works. It's quite an unusual one, and most people think that I'm crazy when we say that to them, but it is the case. Other things that can frustrate me with advice that people are given when they're dealing with loss-making figures is that if you're originally profit-making and the R&D actually sends you into a loss-making position, sometimes the application of that loss is not applied correctly or not to the full benefit of the client. In some instances, I've seen where a company has been profit making, they make an R&D claim and it goes into a loss making position. Now that loss can then be carried back to the previous financial year if that was a profit making year, or it can be carried forward for on the future loss, or it can be cashed in. So the instances that I've seen where this has been incorrectly applied is for a company that's quite mature in claiming R&D tax credits. They're constantly engaged in qualifying activity, so there is a claim every year. The instances that I've seen where it hasn't been correctly applied is more to do with the lack of joined up thinking within an agency. So this will be where the advice may be to say, well, okay, we've reduced the profits, so that's going to disappear, but you're also going to have a loss. We recommend either you carry it forward, which will give you a 19% benefit, or you cash it in now, which will give you 14.5% benefit. So it seems that carrying it forward might be the best thing to do, because obviously the benefits is higher. But the problem is, if you're always claiming R&D tax credits, you're going to be having a preserved loss that's just going to carry on and on and on and on until basically the end of the scheme. So the problem that you have is that the client thinks that they're getting a bigger benefit, but they don't see any cash. They're not going to see anything for quite a long time. Of course, if the following year it's going to be enormous profits, way bigger than what the R&D scheme would knock out, then yes, okay, carry it forward, preserve it and utilise it then. But if you're fairly certain that the year is going to be very similar to every other year, then clearly taking the cash tax credit in the year that you incur it is actually a better option. Not as beneficial in terms of pure numbers, but in terms of cash flow and right now, that will probably be a better arrangement. And that I have seen that in a few instances where, I don't know, the client wasn't aware of this, or they weren't aware they could never cash it in. So it needs some alignment in the thinking in an organisation to say, okay, based on the analyst's experience, is this the right thing that we should be recommending to the client? As an analyst, you would say, no, every claim I've done for the last few years, we can see that the profit is usually around about the same. The R&D claim goes up and down, but not by massive amounts. So it would seem reasonable that we would actually advise you to cash it in. Not as beneficial, but that would be the thing to do.